Welcome to our second webinar. In this webinar, we're going to be going over going from small multifamily to large multifamily, some of the advantages. So welcome again. Thank you for joining us. I'm here with my co-host, John Ortiz.
Hello, guys. We'll be doing our webinar today on jumping from small multifamily to large multifamily. So hope you guys learn a lot and help you guys through this awesome presentation that we made here for you.
Okay, so let's take it away. All right, so this is going to be a table of contents. This is some of the things that we're going to be going over. So the first one is going to be introduction to the team. Second one is going to be the difference between large and small multifamily properties. Third is going to be the disadvantages of smaller multifamily investments. Fourth is going to be the benefits of investing in large multifamily properties. Fifth is going to be myths about large multifamily. Sixth is going to be how to invest in large multifamily properties. We're going to do some case studies. And then lastly, we're going to be doing some investment opportunities and then the conclusion. All right, so John, take it away.
Absolutely. So here we're just going to do a quick, briefly introduction on who we are. Who is Ortiz Equity Group? We are a team of experienced real estate professionals who specialize in acquiring and managing multifamily properties in the U.S. We understand the challenges of investing in real estate, especially when you're short on time. And that's what we are. We offer a passive investment opportunity that allows you to invest in a diverse portfolio of multifamily properties without having to worry about day-to-day management. And we're just going to quickly talk about our team here, which collectively has over 50 years of experience and has a track record of success across various industries ranging from hospitality to government, small businesses, and finance. We've got Charles Seaman, who is a managing partner, Paul Sr., Prashant, Ryan, and myself and my partner Jeff, with a combined record of 17 deals completed to date, 7 full cycle deals completed to date, around 1,600 units under management, 146 million assets under management, and around 250 million in total transactions. And some of the assets that we are involved in is North Carolina, South Carolina, Florida, Texas, Arizona, and more. Next slide, Jeff.
Okay, so I'm going to be going over these next few slides. So it's going to be the difference between large and small multifamily properties. So what is a smaller and a larger multifamily property? So when we talk about small and large multifamily properties, we are referring to the number of rental units that are contained within the property. So a small multifamily property typically contains 2 to 50 rental units, with a large multifamily property typically containing from 50 to 500 plus or more rental units. So as you can see here on the slide, on the left side, we have a smaller duplex. That's actually our very first duplex we purchased. So the side-by-side duplex. And then on the right side, you have a 137 unit apartment complex, which is also one of our assets down in South Carolina. So as you can see, just a quick view of the difference between the two. Okay, so what are some of the differences between the two? So one of the key differences between small and large multifamily properties is the level of economies of scale that can be achieved with larger properties. So with larger properties, the fixed cost of maintaining, operating the property can be spread across a greater number of rental units, resulting in lower per unit cost. So for example, the cost of hiring a property manager or maintenance staff can be spread across a large number of units, reducing the cost per unit for each tenant. And we actually see that in some of our bigger assets, that we're able to hire a better property manager and have a better maintenance staff, as opposed to the smaller duplex. There's no way you wouldn't even have maintenance staff on those. Second point here is another difference is the level of professional management and on-site staff that can be provided with larger multifamily properties. So larger properties can support a full-time property manager or maintenance staff, which can help ensure that the property is well maintained and that the tenant needs are promptly addressed. And this is very important when you have a lot of competition. It's very important that the tenants are well taken care of. So this actually is one of the main benefits of the larger multifamily. Now, in contrast to smaller properties, smaller properties may not be able to support a full-time staff. Definitely a duplex, triplex, fourplex would not be able, just because there's not enough rental income coming in from those units, which can result in delays in responding to tenant requests or addressing maintenance issues. So lastly, there may be difference in the level of competition and potential for price volatility between small and large multifamily properties. Smaller properties may be more susceptible to price fluctuations due to their limited pool of potential tenants and competition from other landlords in the area. In contrast, larger properties may have a larger pool of potential tenants and may be less susceptible to price volatility due to their size and economies of scale. So basically what we're talking about here is that because of the larger properties, we also have a lot of really cool amenities with the larger multifamily properties, like a pool, so they have golf parks in there, they have dog parks, they have tennis courts, all types of really gyms, right? So there's a lot of cool amenities, so we're able to attract a better quality tenant as opposed to a duplex or a triplex where you're not able to accomplish that. Okay, so John, go ahead.
Here we're going to be talking about some of the disadvantages of owning and working with smaller multifamily units. Next slide, Jeff. So some of the points that we're able to gather here are higher operating cost per unit. Smaller multifamily properties often have higher operating costs per unit than larger properties. This is because some costs such as property management, marketing, and maintenance expenses are spread across smaller numbers of units, increasing the cost per unit. Limited access to professional management and on-site staff. Smaller properties may not have the resources to hire a full-time property manager or maintenance staff, and this can result in delays in addressing tenants' needs and maintenance issues, which can lead to lower satisfaction and increased turnover. If you've ever managed a duplex or a fiveplex, you know that this can take quite a bit of your time dealing with tenants, leases, issues, and so on and so forth. And this is another reason why we love larger multifamily units. There's, of course, higher tenant turnover rates. Smaller properties may have higher tenant turnover rates than larger properties, and this is because smaller properties often have more limited pool of potential tenants, making it more difficult to find new tenants quickly when the unit becomes vacant. Higher vacancy rates. Smaller properties may also have higher vacancy rates than larger properties. This is because the smaller properties are often more susceptible to the market fluctuations and may have smaller pool of potential tenants to draw from as well. Limited to potential for economics of scale. Smaller properties may have a limited potential for achieving economics of scale, which can result in a higher cost per unit. For example, a smaller property may not be able to negotiate the volume discounts on maintenance or repair services, resulting in a higher cost per unit. Limited access to financing. Smaller properties may be more difficult to finance than larger properties. This is because lenders may see smaller properties as riskier investment and may require higher down payment or higher interest rates to compensate for the perceived risk. The higher you go, and we know that the higher you go in units, essentially the cheaper the unit gets, and you're able to offset that with the economies of scale when you have 200, 300 units plus can really go to your advantage.
Yeah, and something I just wanted to add to that, just from personal experience here, is that we've actually had duplexes in the past, and when we've had one tenant essentially leave the unit, we were 50% vacant, at some time even full 100% vacant. Whereas with a larger multifamily property, if we had 2, even 10 tenants not occupying the units, it wouldn't impact us because there's only 10% vacancy as opposed to the 50 or 100% vacancy. So just wanted to add to that, but go ahead. Okay, so now here we go. We're going to talk about the benefits of investing in large multifamily properties. All right, so some of the benefits of investing in large multifamily properties, the list highlights some key benefits. So the first one is, I think we've touched on it before, is the economies of scale. According to a study by the Urban Land Institute, large multifamily properties benefit from the economies of scale, resulting in lower operating expenses per unit compared to smaller properties. This can lead to a higher cash flow and improved returns for passive investors. Second point here is professional property management. The National Apartment Association suggests that the professional property management in larger multifamily properties can lead to an increased tenant satisfaction, reduced vacancies, and more efficient operations. This can alleviate the burden of passive investors who prefer a hands-off approach to property management. Third is diversification. The Multifamily Housing Council reports that larger multifamily properties offer a greater diversification due to larger number of units and tenants. The diversification can help mitigate risk and reduce the impact of vacancies or non-payment by individual tenants, ensuring more stable cash flow for passive investors. And something I just want to add to that point is that when we are underwriting deals for the larger multifamily properties, we're always putting in a vacancy already in place to buffer for whenever there's any vacancy. Whereas with the smaller multifamilies, it's very hard to do that because your cash flow is so limited. So fourth here is cash flow stability. Industry data indicates that the larger multifamily properties tend to have more consistent cash flow compared to smaller properties. The National Real Estate Investor suggests that the economies of scale and a diverse tenant base contribute to the stability, providing passive investors with a predictable income stream. So again, that's a predictable income stream, which is very hard to accomplish in this DNA with many different investment vehicles like stocks, mutual funds, and so on. Fifth, financing opportunities. Commercial real estate financing trends shows that the lenders are often more willing to finance larger multifamily properties due to their income generating potential and low risk profile. This can provide passive investors with better access to favorable financing terms, making it easier to acquire and leverage large multifamily properties. And just to touch on that, it's actually, believe it or not, it's actually a lot easier to get financing on a larger multifamily property than it is on a smaller multifamily property. And some of the points to that is just that on the smaller multifamily property, they're still looking at your income and your personal income and your personal debts. Whereas with the larger multifamilies, is valued based on the business, based on how the property is performing, which is really a huge benefit as we're scaling. All right, so go ahead, John.
Now we're going to move on to the top 5 myths about investing in large multifamily properties. All right, so the myth number 1, large multifamily properties require extensive management involvement. Fact is, contrary to popular belief, larger multifamily properties can be managed effectively with minimal involvement from passive investors. Partnering with professional property management companies allows passive investors to delegate day-to-day operations, tenant management, and property maintenance, providing a hands-off investment experience. Next slide, Jeff. Large multifamily properties are too risky. Fact, while all invests carry some level of risk, large multifamily properties can offer risk mitigation through diversification by having a large number of units and tenants. The risk associated with relying on a limited number of occupants is significantly reduced. Additionally, working with experienced professionals like ourselves and conducting thorough due diligence can further mitigate risk. Financing large multifamily properties is difficult. Obtaining financing for large multifamily properties can be easier compared to smaller properties. Lenders often view these properties as more stable and income generating, making them more likely to offer favorable financing terms. And passive investors can take advantage of this by leveraging their general partners' team's track record and net worth to maximize returns. Next slide, Jeff. Large multifamily properties are only suitable for active investors. Large multifamily properties can be an excellent investment choice for passive investors. With professional property management in place and asset management team with a track record, passive investors can enjoy the benefit of income generating, potential appreciation, and diversification without the need for active involvement in the day-to-day operations, unlike smaller multifamily properties. This is why we love the larger multifamily properties, because we're able to have all of our investors combine in a project that's 250 units and it's cash flowing from day one, and they're able to just sit back and enjoy their returns.
Yeah, and something I just wanted to add to that is that back in the past, these opportunities were only available to high net worth people, and only banks would actually go into some of these asset classes. But because of the way the world is and the way the technology is, investors that actually have access to these type of investment opportunities, which in many cases would not have access to just because of finding the deal, qualifying for the deal, underwriting the deal, and so on. So it's just a great opportunity to be able to, like John mentioned, be a passive investor and enjoy the true benefits of being a passive investor with a hands-off approach.
Myth number 5, large multifamily properties lack cash flow stability. Fact, in reality, large multifamily properties tend to exhibit more stable cash flow compared to smaller properties. With a higher number of rental units, the income stream is less susceptible to fluctuations caused by vacancies or non-payment by individuals. This stability can provide passive investors with consistent and predictable cash flow. Next slide,
All
Jeff.
right, so that was the end of the myths there. So we hope we were able to crush some of those myths that we have heard or we have thought of when it comes to larger multifamily. So now we're going to be talking about how to invest in larger multifamily properties, right? There's always, it's a great investment, but how do we do it? All right. So we're going to be over that. So one of the best ways to get started with large multifamily property is as a passive investor. And that's actually how we got started. As a passive investor interested in investing in larger multifamily properties, syndication offers a viable avenue. Syndication involves pooling capital from multiple investors to acquire and manage properties. This list outlines the steps by step for passive investors to invest in larger multifamily properties via syndication. As our target avatar, we provide you with an opportunity to invest in the syndication deals. Here's how passive investors can invest in large multifamily properties via syndication. So number one is research and due diligence. Identify reputable syndicators. Conduct thorough research to find experienced syndicators who specialize in larger multifamily properties. Evaluate their track record, investment strategy, and communication practices to ensure alignment with your investment goals. Part of that, second point here, review investment offerings. Syndicators provide detailed investment offerings, outline the property financial projections, risk factors in terms of the syndication. Review these documents carefully to assess the investment opportunity. Step number two, establish communication and relationship. Engage with the syndicator, initiate communication with the syndicator to express your interest in participating as a passive investor, request additional information or schedule a meeting to discuss the investment opportunity and clarify any questions you may have. Now, in our case, we are one of the only, not one of the only, but I guess we're one of the main people that are Canadians that are investing in the US and are allowing Canadians to passively invest in the US. There isn't a whole lot of folks in our space doing this. A lot of folks in the States are already investing. So, that is something that we just kind of want to put out there. Now, second point to that is build a relationship. Cultivate a relationship with the syndicator by maintaining open and transparent communication. This will foster trust, help you stay informed about future investment opportunities. This is part of the reason why we do these webinars, the monthly meetups, our podcast. We just want to engage and we want to communicate. We want to have a relationship with our investors as much as possible. Number three, understand the investment structure. Syndicators typically involve a general partner, also known as a GP, and a limited partner, also known as LP. The GP is responsible for managing the property, while LPs contribute capital and have a passive role. Second point to that is review legal documents. Carefully review the private placement memorandum, also known as a PPM, and operating agreement, which outlines the terms, rights, and responsibilities of the syndication participants. Seek legal advice to ensure you understand the legal implications. Step number four, assess financial and investment returns. Review financial projections, examine the syndicator's financial projections, include rental income, operating expenses, and projected returns. Evaluate the assumptions and ensure they align with your investment objectives. Evaluate return on investment, ROI. Consider potential cash flow, appreciation, and tax benefits offered by the syndicated investment. Assess the expected ROI over the holding period to determine if it aligns with your investment goals. Now, another point I wanted to touch on that is when we are analyzing a property, we're usually looking at the cash on cash return, which is basically if you invest $100,000, what is your cash on cash return year over year? On average is usually typically 8 to 10% cash on cash. That's what we tend to look for. And there's also two other metrics that we analyze, which is ARR, annual average return, and IRR, internal rate of return. Step number five, commit capital and participate. Make an investment commitment. Once you have completed your due diligence and are satisfied with the investment opportunity, commit your capital to the syndication. Follow the instructions provided by the syndicator for submitting your investment funds. Step number two within that, stay informed and engaged. Maintain regular communication with the syndicator to receive updates on the property performance, financial reports, and any significant developments. Attend investors meetings or webinars to stay engaged and informed about your investment. Now, one thing that I wanted to add that we do with our investors is that whenever we're doing any due diligence or whenever we're doing any walkthroughs on the assets, we actually encourage our investors to come to the walkthroughs with us, to walk the properties with us so they can see and understand what is it that they are investing in. All right, so now we're going to go over a few case studies. So I'll let John kind of take that away and just kind of just some high level on these.
Thanks, Jeff. Appreciate it. These have been some of the properties that have gone through a full cycle. So I'll quickly touch base on some of these. We've got here Vineyard out in Riverdale, Georgia, which is a great market with growing population and lots of demand for rental units. This was 108 units. The actual internal rate of return was 28%. The equity multiplier was 1.8. Sale price was at 8.25 million. The disposition date was February of 2022, and the project was held for 36 months. Deal structure was a 65 and 35 split between limited partners and general partners. So as you can see on this deal here, a great investment for our investors. They're really happy with this one. We're able to offload it with half of the anticipated hold period.
And I just wanted to, I just wanted to touch base quickly for folks that may not know, what is a multiplier? So in this case, what is a 1.8 multiplier, John?
So essentially that means that is your equity that you've made throughout the lifetime of the deal. So if you have invested,
so let's just say you invested 100,000. What would a 1.8 be? If you invest 100,000, you would essentially get 180,000 back at the end of that term. Correct, John?
That is correct. That is correct.
Okay.
So again, this is probably way better than and safer than investing in stocks. This is held against a physical asset, and this is another great opportunity why our investors love the diversification into multifamily properties.
Awesome.
The South Lake Cove here in Georgia. We love the Georgia area. Very high end demand for rental properties. Here it was 368 units. Actual RR was 28%. Equity multiplier was again 1.8. Sale price was 26.4. Held for 36 months, and project cost was around 20 million. And acquisition date was back in 2019. So as you can see, another beautiful asset here. We're able to fill this one out pretty quick, but this was another great project that we're proud of present and talk about. Moving on to the next slide, Jeff.
Yeah, these again, guys, these are some of the projects that our team, ourselves and our team have completed. So just to kind of show you a little background on the team and what investors can essentially expect. And this is having a track record, and a team with a track record is really important when you're investing into these larger deals. Go ahead, John.
Yeah, absolutely. So as you can see, we're going in and out, and we're turning over assets and tenants, and actually multiplying our equity. Here we have on the left side, Huntsville, Alabama. Huntsville is a great market. 390 units. Actual internal rate of return on this one was a little higher. It was 22%. Equity multiplier 1.45. Project was held for 30 months, but the anticipated was 60 months. So again, moving here very quickly. We always have an extra buffer on all of our anticipations. We try to underpromise and overdeliver on all of our investments. Here on the right side, we have Westwood Park out in beautiful Alvin, Texas. And this was 128 units, 24% internal rate of return, 1.65 equity multiplier. And this one was held for 40 months when it was anticipated for 60 months. So we're able to go in and out very quickly on these properties. And the deal structure on this one was 80-20.
And I just want to really jump in there and really nail in what we're talking about here. So when they talk about project costs, that is what the purchase price was. 13 million project cost, and sale price was 33 million, right? So just to kind of really touch base on that. Okay, so I'll be going over this here. So this is the taxes when investing in the US as a Canadian. Below, you'll find below the graph we use with our professional cross-border accountants and team for best and most efficient way to invest passively in the US. Again, guys, we are not CPAs, so do seek legal advice. But we always like to share this because a lot of our following, a lot of our investors are Canadians. So we just want to make sure we can kind of quickly show a graph of what it looks like when you're investing into some of these deals as a Canadian, right? Because that's always a big hurdle is like, how do I invest if I'm Canadian? What about the taxes and so on? So I just want to touch on the pros here as a with this diagram that we have here. So the pros, and one of the most, I guess, most important one is no double taxation. Again, no double taxation. So you're not getting taxed twice. There is a liability protection, ease of doing business, and then additional asset protection for each asset of real estate property. So just wanted to quickly touch on that. If you guys want to learn more about that, or if you guys want to learn more about this particular thing, just schedule a call with us and we'd be happy to kind of go over that. Go ahead, John.
Yeah, thanks, Jeff. I appreciate that. We have a current investment opportunity, and we already have 78% subscribed. So we're almost filled here on these amazing opportunities. Probably one of my favorites out in Atlanta, Georgia. If you want to learn more about this project, please schedule a call. Just to make a highlight on this investment, it is a assumable loan at 3.14%. These are rates that we're not seeing anymore. These are 2018 rates, and there's a lot of life left on this loan. So we're able to optimize our return, our ROI, high cash on cash. So if you're interested, please let us know. There isn't that much time left. So
John, just to kind of touch on this, if you don't mind answering this, how much of the units have been renovated?
So the previous owner had renovated 230 units already. So that's amazing. And there's only about 6 more units that need to be fully updated. There's a couple of expenditures that we're going over as far as interior and exterior, just to keep on pumping that force evaluation on this property. But other than that, this is an amazing opportunity.
Awesome. Yeah, so basically the previous owner did some major capital expenditures in the inside interior of the property, meaning is a pretty well turnkey property, but he wasn't an operator himself. So there is potential to keep increasing the rental income, so the monthly income, as well as lowering some of the expenses. So we're able to just identify how we can lower the expenses, therefore increasing the NOI and therefore increasing the value of the property and offering our investors some really good returns. Now, just one thing I wanted to add to this opportunity is open to accredited investors only. So this is a 506C. We also do have some 506Bs, but for that, you'd have to schedule a call with our team to learn more. But yeah, that's awesome. And last but not least, we just want to thank you guys. We want to thank you guys for joining us on our second webinar.
If you don't mind, I actually just wanted to just highlight a couple more points here on the difference.
Sure. Yeah.
So the small multifamily property sector is defined as those properties with between 5 to 15 units. It is a sector that has long been focused for affordable housing because it is generally regarded as having more affordable units. For example, according to a report that we're able to pull up from CoStar, as of the fourth quarter of 2022, the average asking rent for a unit in the existing small multifamily property was $1,200, somewhat less expensive than the average $1,500 for a larger unit on a 50+ unit multifamily property. So you can see that it varies even just on the rental cost between smaller and larger multifamily. Smaller multifamily properties tend to go towards having more affordable units for housing, when the larger multifamily property, it's more of your higher end consumer. Another great point that the report shows that the difference on nationwide on the average monthly asking rent for small versus large multifamily apartment is about $400 difference. So that's the average of the difference between the two. And that when you're doing your turnover and optimizing your net operating income, the value that can significantly add towards the end is very large. So just wanted to add that out there.
Thanks, John. I appreciate that. And yeah, lastly, we just want to thank you guys. We want to thank you guys for joining us on our webinar tonight. This is our second webinar. We're planning to host these every month. So we hope you found the information informative and valuable. As we continue to grow and invest in multifamily real estate in the US, we'd like to invite you to join our investors list to be notified of future investment opportunities. By joining our list, you will have access to exclusive investment opportunities and updates on our portfolio. We look forward to working with you and helping you achieve your investment goals. Thank you again for your time and support. Anything else you want to add, John?
No, I'm good. I think everything's good.
Awesome, guys. Well, without further ado, we thank you guys, and we'll see you on the next one.